The tariffs have officially arrived. That's 25% across the board, 10% on energy. Let's dive in. Tariffs were on the table. This wasn't a surprise. It was telegraphed for months. But the real question now is, are they here to stay? And if so, what do we do? How the heck? Sell the house! Sell the farm! Not quite. There are two scenarios here with different takes on the trade game plan moving forward. Now, scenario one assumes that this is posturing, that tariffs are a tool for negotiation to control trade and other policies. So far, this has been a wide variety of policy asks, from fentanyl control to illegal border crossing control to defense contribution demands. By now, we're familiar with that cycle. There's the threat of tariffs with the announcement, followed by a phase where Canada makes some concession. Pressure fades, and the cycle begins anew when the next demand comes up. We've lived this. It's been our 2025 so far. But the longer Canada persists in this space, the more time it has to be able to redirect trade and supply lines that realistically can't shift overnight. We are still within reach of this cycle with a short-term reversal, even though the tariffs are now live. If the cycle repeats, it's just an unpleasant but at least predictable reality of doing business through this administration. And the impact of the tactics should dissipate over time. What moved markets today is fear over scenario two. The tariffs are implemented and that they hold. They aren't a bargaining tool. They're a long-term restructuring of trade. Now, we're going to talk our way down that path and look at the order of operations for that plan should it unfold. But before we do that, let's take a step back. Where did this come from? The strategy didn't just appear out of nowhere. It's based on a paper written by Stephen Moran, a former US Treasury official and Trump's pick for chair of the Council of Economic Advisors. His argument is that tariffs can rebalance trade, strengthen US manufacturing, and very critically, not cause runaway inflation. How, you may ask? This is the they pay the tariff argument. It's not a debate over who directly pays the import tariff on goods. That's just that first level knee-jerk interpretation that gets paraded over late night media, the one where they find some poor soul off the street that is under the conviction that other countries are just paying this cost directly, simply for the pleasure of doing business with the US. It's a silly argument, it's not the case, and honestly, shame on them for making fun of these misguided people. They pay the tariff is detailed in Stephen Moran's white paper, which is titled, and get this, A User's Guide to Restructuring the Global Trading System. If there's a way for these economists to make these concepts more complicated and somewhat threatening, they will take it, and that's why this has hit the desk of every Wall Street and Bay Street firm. Now, the thesis is that tariffs start by driving inflation, or the rising cost of goods. This is for the import-dependent economy that holds the reserve currency, in our case, the US and the US dollar. Prices go up domestically, but there's also less US dollars going out the door to other countries. As US dollars change hands only and primarily within the US, and the government incentivizes US businesses to grow, other countries view US investments as attractive and purchase US dollars to invest in that growth. The currency strengthens. Meanwhile, the export-dependent countries are put in a very difficult position. They need to act to intervene in trade-threatened industries through government spending and through rate cuts. The extra debt and the low-rate environment devalue that local currency. So while the US consumer absolutely paid the tariff directly, I hope that was never up for debate, their currency, the US dollar, has appreciated, while the exporting currency, the Canadian dollar, has depreciated. The US importer can now buy more Canadian goods and services due to currency value alone. As long as the 25% tariff affords an American importer at least 25% more in Canadian goods due to currency, guess what? The Canadians paid for it. It's an interesting theory, and it works in a vacuum where other variables are held constant. But two of the economists Moran cited in his work have already come out against its real-world applications, saying their research was misinterpreted and that these tariffs are, in their words, a very bad idea. So where are the holes? They argue that this approach assumes no retaliation. With exception, the paper indicates security policy would be leveraged. No global supply chain shifts, though, and no unintended second-order consequences. If history tells us anything, it's that trade doesn't happen in some vacuum, and that some of the immediate actions we saw today indicate that other countries are already digging holes in Moran's argument. Second-order consequences could include accidental offshoring, where US manufacturers that have their end markets elsewhere simply relocate outside of the US, so they don't have to contend with border crossings and importing materials. That works against the goal of bringing manufacturing jobs back. The big potential consequence is the risk that the US dollar risks its status as the global reserve currency for trade, and that's a whole other segment. Okay, so let's walk through what happens if these tariffs remain in place, starting with Canada. Step one is immediate economic disruption. That is the bad. Short term, it is very bad. We'll see trade-sensitive industries like automotive, plastics, agriculture, construction, and mining take the hardest hit right off the bat. And if you don't retaliate, you just let Moran's thesis play out. So I guess retaliatory tariffs it is. Canadian exporters face higher costs and declining demand from their primary trading partner, which was the US, and the effects ripple outward from there. Now in step two, the Bank of Canada moves to cushion the blow. If you're going to survive transition time to realign all of your trade allies and supply routes, you're going to need the most accommodating lending and rate environment Canada has seen. So the rate cutting cycle that started last summer accelerates. In this scenario, we're likely headed to near zero again. And quantitative easing, yes, that printing press we used through COVID, could return to stabilize markets and employment. That's very much a back pocket tool, as we're still very much paying for the last time we whipped it out. Step three is that there's a government stimulus and industry response. Canada likely launches its largest manufacturing and resource sector investment in 30 years. The government steps in with spending programs to accelerate manufacturing and exports and gets very, very lenient with trade limitations on non-US trade partners. Corporate borrowing costs collapse due to the rate environment, making expansion cheap and efficient for Canadian companies. At the same time, interprovincial trade barriers start to come down as the government scrambles to strengthen the domestic economy and immunize against the US dependency. Part of that might be a big stretch historically is we would need to have full coordination between the provinces themselves and the federal government. Now, step four, the loonie depreciates, but over time works its way back up. In step two, rates had dropped. The Canadian dollar had weakened, making imports more expensive. But over time and optimistically, Canada becomes an attractive alternative trade partner for the rest of the world, restoring demand for Canadian dollars. Now that part doesn't happen overnight, and for the short-term pain, we're still very much relying on a burst of stimulus from steps 2 and 3. Once trade stabilizes, Canada can return to moderating its policies, though there's certainly going to be an expanded debt load to address. That's a problem for future Canada. On the flip side, let's talk about the impact on the US. Now, step one, inflation rises rapidly. Tariffs are effectively a tax on imports, raising prices of the final good. And the US economy still relies on foreign materials, such as metals, fertilizers, critical components, so costs rise across the board and inflation accelerates. Going back to Moran, a strong US dollar should offset those costs, but that only works if supply chains don't shift, if industry stays onshore, and if retaliation tariffs haven't completely trashed demand for US goods. I guess fingers crossed on those ones. Step two, trade-sensitive industries see job losses. While the goal was to bring manufacturing back home, supply chains don't adapt instantaneously. Businesses relying on cross-border trade face cost increases and lower competitiveness, resulting in layoffs and a mini version of Canada's economic disruption. Unemployment still rises in affected sectors. Step three, the Federal Reserve is forced to act. Now the Fed has two competing priorities, rising unemployment and rising inflation. Now traditionally you'd expect to cut rates to address rising unemployment and raise rates to cool inflation. But under pressure and acknowledging that high rates don't change tariff policy, they'll begin cutting rates. Asset prices such as stocks, real estate, gold start moving up as capital seeks yield. In step four, ultimately, the US faces a credibility challenge. The assumption that the US can impose tariffs unilaterally without damaging global confidence starts to crack as nations accelerate their pivot away from US dependency. Devalued currencies make other trade partners more attractive options in the long term. The strength of the US dollar as a global reserve currency really faces its first real challenge since the pandemic era stimulus. This part is the make or break. So the end game, what happens next? Well, if the scenario plays out, we end up in a very high stakes balancing act. And we've got to keep in mind that all the while, at every point in this unfolding, Trump holds the policy lever to reverse course at any moment. If inflation gets too high, if unemployment spikes, if markets react negatively, he can rescind the tariffs by executive order. Politically, that's a victory. That said, if this gets reversed tomorrow, there's still going to be a lasting effect as nations diversify trade and supply lines. Despite that, there's probably going to be a short-term economic boost. But if tariffs persist, then we enter a longer-term realignment of trade, where Canada has to capitalize on new trade flows, and the US has to navigate the consequences of its own policies. And this is where the policy becomes high stakes. If the US has to reverse course and stimulate their own economy, there needs to be a buyer left for that US dollar debt. At that point, the question isn't just about trade. It's about whether US fiscal dominance is sustainable in a world that's actively hedging against it. What do you think? Are we cycling around scenario 1? Or dipping our toe into a new trade landscape with scenario 2? Our portfolios have it covered, but we want to hear from you.